Welcome. We're delighted to see folks here I guess it's afternoon now. I'm Mark Bonham from Mayer Brown, and we have some other Mayer Brown lawyers here. If you want to talk with someone and you want a particular expertise or it's a question that not anybody would be able to answer, just grab somebody who has a Mayer Brown tag and we'll be glad to point you in the right direction. We are also broadcasting this one or streaming it. So hello to you folks out there in Zoom land. We're glad to have you with us as well. It's a pleasure to be able to introduce two of my partners, and we'll be talking about something that, in a sense, built the technology industry over the last 50 years, which is equity compensation. That's why people work long hours and invest their best ideas and do everything they can to make their company succeed. It's not just the paycheck, it's the upside and the stock options. So we will learn some more about that. I'd like to introduce on my far right, Ryan Liebel, who is here to talk about especially the compensation aspects of it. And then the really tricky stuff, is that fair to say? Does that hurt your feelings? On my right, not quite as far away, is Remmelt Reigersman, who has a tax background and understands some of the sophisticated and complicated and sometimes frustrating aspects of the Internal Revenue Code of 1986 as amended. So I'm going to turn the time over to them and let them kick off, and we'll just follow the agenda. Please go ahead and eat, and we'll look forward to answering any questions after, or they may take questions as they go. Remmelt?
All right, thanks, Mark. Let's see, I've got a few housekeeping items before we get into the presentation. We've got CLE credit. For those who want it, we will read the CLE code out loud when it appears, and you'll see it on the slides. CLE forms have been distributed via email if you're not here, or you should have been given one in person at the check-in desk. And once completed, those forms can be emailed to cle-events@mayerbrown.com. Or you can give it to Ryan or Hanson here. Ryan over there, Hanson by the check-in desk. And then any questions that you have during the presentation, let us know. And for those attending remotely, questions that will go into the chat box, we will address towards the end of the presentation. With that, Ryan, do you want to kick it off with your topic?
Sure. Happy to jump in. So the agenda, if you want to hit the slide, this is kind of an overall. Remmelt and I will go back and forth just by way of background. I'm the compensation specialist, so do all the work on the equity comp, executive comp type issues. Structuring all the different stuff we'll talk about. Remmelt is more of an entity tax specialist, so needless to say, we work together all the time. He'll cover the qualified small business stock issues. We'll both cover FF stock, and then he'll cover the Up-C structures, more on his end, and then I'll do. So, as we got started on this, so Remmelt will follow up at the end. As they offered this to a live audience, I was teasing a friend. I'm like, oh yeah, there's just so much demand. We're like Taylor Swift, like Remmelt and I get on the road again, and it's just overflow, right? And my friend was like, yeah, that's cute, Ryan, but Remmelt is Taylor Swift. And I'm like, okay, fair enough. So we got to save the best for the end. So I'll try and get through these initial slides quickly so we can get to Remmelt. I also want to say here in Utah, it's great to come to some snow-covered mountains, by the way. Chicago, for those of you who know where I'm coming from, is flat to the point of absurdity. And having lived in mountains, it's always nice to be back and see the snow. So thanks for accommodating us and a nice visit that way. It was nice to wake up this morning. Okay, so jump into the slides. So advantages and disadvantages of different types of equity awards for private companies. So if you were to come to someone like me and say, hey, we want to put in a plan, let's talk about what's some things that make sense. We're going to do a high level of the type of discussion we'd have at that point. And I want to go through some high-level issues initially. It's not a one-size-fits-all. It does vary, but there are some trends that emerge depending on the type of company that you are and sort of the stage and the life of the company that you are. There are some trends. You don't have to do what everyone else is doing, but at the same time, there's always a balance there, because if you do something that's so far different than what employees are expecting, you may get some market pushback for retention, right? So you have to kind of balance those things. So go ahead and jump, if you would. So overall, it's always helpful to back up. Why are you doing this? Why do companies do this? It's the magic words. If I had a dime for every time I've said this in my career, I would probably be able to retire. You pay for performance, right? That's what everyone does. Public companies say it in every proxy. They say it in every presentation. Private companies are trying to do the same thing, pay for performance. The key is equity awards or equity-like instruments, of course, are designed to align the service provider's interests with the shareholders. But it matters a lot who your shareholders are, right? So lining up interests with shareholders. Public company shareholders are coming and going. There's no sort of set group of shareholders that have a specific timeline that you're trying to line up with. Whereas like private equity, they're the shareholders and they want to line management up exactly with their desired return, right? We're going to be invested in this company for 5 or 6 years and we want you to make this amount of money in 5 or 6 years. Whereas then if you're a growth company and you have venture capital, you're going to have some different versions of that. Investors coming in at different times, and they may want to strike different equity comp arrangements when they put money in, what they want to motivate the employees to do for the next wave of growth for the company. But again, in theory, it's always trying to align those interests. The win-win. When the employees do well, the investors do well, and vice versa. Okay, next slide. So as we talk advantages and disadvantages, it's always helpful to talk about what people want. Like, what is the advantage? And of course, what the employee wants is in tension with what the company wants. They don't want the same thing. And to be honest, the tax code is designed with that tension in mind, because the theory is the better the employee does at avoiding taxes, the more likely the corporation or entity's taxes are going up. It's not perfect math, but if you structure a program that gets the employee capital gains, the company loses the deduction. If it's ordinary income, the company gets a deduction. So that tension is helpful, actually. And the IRS is very aware of that tension, and it's part of sort of the background that's always going behind these rules, what's going on. So in an ideal world, I've sort of, over the years of doing this, typed out this is what I think executives, if you could sit an executive down, this is exactly what they would want. They don't want to pay tax until the equity is sold. They want it to be capital gain treatment, not ordinary income tax. And they don't want to have to put money at risk. That's the perfect home run, right? No risk, capital gain, deferred taxation until they sell it. It's a home run. And that actually, you can get pretty close to that with profits interest. If you have a pass-through partnership structure, you can get pretty close to that. There's some disadvantages, but you can get pretty close to that. The company, of course, in that structure loses the compensation deduction, so that tension is there. Better for the employee, but worse for the company. But in the corporate structure, you can't get there. So if you have a corporation and you're trying to design something, you can't get the employee there. And the key difference is you have to have a point in time. If an employee wants capital gain, they have to put money at risk. So we'll get into the differences. There's different times when the money has to be put at risk, but you can't get capital gain in a corporate structure without some risk. So it's important to note. I will also note, for those of you that follow the news, this is the great unfairness that a lot of Democrats hit on at times, that they say the profits interest is too good to be true, that it's an unfair form of taxation because it allows people to effectively totally avoid ordinary income. Whether or not you agree with that politically, I just want to note that's what they're talking about when that comes up, right? That's the issue. Incentive stock options are the closest you can get to this in a corporate structure. But even in an incentive stock option, you have to put money at risk for a year. So you have to buy the stock and hold it for 1 year before you can get capital gain tax treatment. So you can get there, but you have to put your money at risk. Okay, next slide. Here's a couple slides just on what I see typically for the different types of companies. And I do want to hit this as a highlight because, again, as we slot in the different types of awards, this tends to be where you see more of the different types of awards. It's an overgeneralization. But if you're at the private company early stage, cash comp is low. Founders typically get restricted stock. Other employees often get incentive stock options. And there's reasons for that we'll get into, but that's typically what you see. Private companies with VC investors, cash comp has started to come up. Still often frequent use of stock options until the company reaches a certain level of value, and then there's a tension on options. As you may know with options that are only an upside award, you only get a portion of what the company gains in value. And if the company starts to hit valuations in the billions, and they may say, hey, there's not as much upside left here, we want some of the full value award, then they may switch to RSUs, but there's some tensions there. We'll get into that in a little bit too, but I want to flag that you do start to see companies using what I call double trigger. I've heard them called Facebook RSUs because Facebook was one of the first companies that used them, to the tune of billions of dollars, but there's some tax issues with those. So if you're a late stage venture capital company, this is a discussion we can have, but I do want to make sure there's clear understandings of sort of the risks and rewards of doing it. And then another issue Rimmel and I get to later is late stage companies where founders who have been there since the beginning want to start selling equity pre-IPO and pre-change of control to other investors. There's a tension that emerges. And we'll talk in a little bit about FF stock as a solution to that tension, but I flag that too. Slide. Private equity owned companies, it's very simple. Well, what they do is simple. How you document it is very complicated. When the private equity investors come in, they make a ton of grants. They grant a ton of upside based on their return. And you hit the numbers, you'll do really well. You don't hit the numbers, you won't get anything. It's the form of profits interest almost always, sometimes stock options, and then often they have you roll and you'll have capital interests. And then public company, typical exec comp, I know this is not the target audience, but it's worth mentioning. They tend to do annual grants. So private companies tend to have grants that deal with cycles of money infusion. So private equity, when they invest, they make grants. Venture capital, when money comes in, grants are made. Public companies tend to make grants annually because they have a turnover in their shareholder base, and it tends to be more linear. So just worth noting is something to understand. It's a little bit of a different, and as you may know, public companies do not use stock options near as much as they used to, and there's reasons for that too. Okay, now we'll get into the types of awards. Non-qualified stock options. This is a contractual right to purchase a share of stock at a price set on the date of grant anytime in the future. There's some great news. There's reasons why these are popular based on the tax rules. Grant is not a taxable event. Vesting is not a taxable event. There is no taxable event until exercise. So that's great news for the holder. So you get one of the goals. Remember how I said the executives don't necessarily want to pay taxes until they sell the shares? You can get there often with a non-qualified stock option because they don't exercise until a liquidity event. So no risk. Money's not out the door till you get your money back for selling your shares. Okay, here's the huge disadvantage of non-qualified stock options. It's ordinary income. So you get those benefits, but you pay ordinary income instead of capital gain tax. And if you flip the page, I have the advantages and disadvantages a little more laid out. A couple other things when you're dealing with equity I'll note as disadvantages that I want to talk about. Anytime you have actual equity, you all probably know this, but you also need to draft in fairly complicated shareholder agreements or partnership agreements that govern the rights. And if you have not yet been through a change of control, the reason you do that is when a change of control arises and you want control of the company to sell it to the buyer. If your equity program does not clearly give you the right to do whatever you want with those equity awards, you're going to need to get consent from your equity holders, and I will tell you that is painful. It's horribly painful. You never want to have to do that. So when this program is designed up front and you're using actual equity, we need to make sure we have everything in place so that if a deal is done in the future or an IPO, you don't go back to equity award holders. They're just along for the ride. They get the economic benefits, but they don't get any control. That's the key. One huge advantage I want to note for non-qualified stock options, the company gets the deduction, and they get the deduction at the time of the IPO or the transaction, which can be a huge advantage because it can really reduce their taxable income at that time. So there is a corresponding advantage to the company. For stock options, though, I want to also note retention value issue. If you grant a bunch of stock options and the economy goes flat or down for a period of a couple years, you have a real retention issue problem, right? Because then suddenly there isn't any upside on the table at that time and people may jump ship. And I want to note, just as something to think about, particularly as the economy right now is in a little bit more of an uncertain timetable, it's not just that the award may be flat for a few years. It's that if they move to a competitor and they get a new grant, The new competitor's grant will be based on their fair market value at that time, which will be lower. Do you see what I'm saying? So it's almost like you're double whammy in a bad position, because you're underwater where you're at, and you can totally get bailed out if you go to a competitor, because they may grant you stock options with the current fair market value, and that will give you a chance at regaining a ton of upside that you've now lost at the other company. So if you're in that position, it's something you need to think about. If you start to have retention issues, you may need to put something else in place to help retain employees. Okay, incentive stock options. 2 more slides, I guess. Here, sorry, Ryan. Incentive stock options are stock options with, they have special tax treatment under the code, where if certain requirements are met, you can get capital gain on the upside. To get capital gain on the upside, the person has to actually exercise the option and hold the share for 1 year. And then when they sell it, they'll get capital gain instead of ordinary income. In my experience, companies spend a lot of time doing work setting up ISOs for this tax benefit, and employees rarely take advantage of it because they just don't think about it. They may not be aware, or again, because you got to put money at risk, a lot of employees may say, well, that's great, but I don't have $100,000 to pay the exercise price to buy the shares to then get this tax treatment. I can't afford to lose the $100,000. So a lot of companies set it up, and a lot of companies, the employees don't see this benefit. If the ISO treatment is not met, then it's taxed as a non-qualified stock option, so it just reverts to the rules I was just talking about. But there's 2 other sub-points on ISOs that I want to note that are important. They are limited on value. You can only grant ISOs up to $100,000 worth of stock pursuant to the option that becomes exercisable per year. So if you grant an ISO to purchase $100,000 of shares, that's fine. That'll work as an ISO. If you grant an ISO to purchase $400,000 worth of shares, but it vests over a 4-year period, that's also fine, because the $100,000 gets analyzed on a year-by-year basis. But if you grant more than that and you trip over the value, anything that goes over the value will switch to non-qualified stock options. So you have to track it. But the value limitation is important, because if you do the math, when does this make ISOs the most valuable? For startup companies, right? Because the $100,000 limit is not as meaningful if the company's early stage and it doesn't have much value. You can grant a high percentage of the company and still be under the value. It's as you start to gain value, ISOs start to become incrementally less and less valuable as a tool. The other important point to note here, and this catches people unawares, and it's very painful when someone doesn't know, when you exercise an ISO, it is not taxable for ordinary income tax. There is no withholding, but it does go into the person's alternative minimum tax for that year. So 15 years ago, this wasn't as big a deal, but the alternative minimum tax limits have not changed for years, so more and more people are fitting into the limit. So this impacts more and more employees, and if an employee is not aware of this, they may exercise the option and think, oh, this is tax-free, I don't owe anything, and then they go to do TurboTax that year and put in the information, and they actually do owe money on the alternative minimum tax. So it's something you want to make people aware of. Okay, so slide. And I think I've covered a lot of these advantages and disadvantages, ISOs. The one other thing I do want to harp on, the not doing withholding is a huge positive, because when you have illiquid stock, if you have to do withholding, it has to come out of somebody's cash pocket, and that can be painful for the employee. So exercising an ISO and not having to do withholding is a huge positive for the employee, because they do not have to pay that withholding tax. So I do want to note that as a huge positive for incentive stock options. Okay, restricted stock. Restricted stock is the transfer of a share subject to restrictions. And I want to distinguish this for those of you who know from an RSU. When you get a share of restricted stock, you get the stock on day one, but you may have to give it back if the conditions are not satisfied. So subject to a substantial risk of forfeiture. That's different than an RSU, which is a contractual right to receive a share in the future. They're taxed differently, and the distinction is important. In private companies, restricted stock, well, let me go through the rule for restricted stock. Restricted stock is the only way you can use these 2 rules that I'm going to talk about that can be very beneficial. If you use restricted stock, the employee can make an election on the transfer of the stock to either pay stock or pay ordinary income on the value of the shares received on the date they receive it, minus any amount paid. So the income inclusion is what it's worth minus what it's paid on the date of grant. Or if they don't make that 83B election, they pay on the fair market value on each of the vesting dates. So if you have a company early stage, and I just had a conversation with one of the Mayor Brown partners this morning about this. If you're a founder, it may make a ton of sense to do restricted stock for the founders and make an 83B election because the company's not worth much. You pay the taxes then, and then from that point forward, for tax purposes, you're a capital owner, and you get capital gain or loss. So as the value goes up, you're going to do a lot better. And you no longer have to pay taxes on vesting. You only then ever pay taxes when you sell the shares, which could be 5 or 10 years down the road. Vesting is not a taxable event. If you don't do that and you pay taxes on the vesting event, it's very painful for a private company. The stock may not be liquid. Somebody has to come up with the cash. It can catch people unawares. And in my experience, it can be very painful. We get phone calls like, oh my gosh, somebody owes all this tax on restricted stock. It's now worth a ton of money and they didn't make an 83B election. What do we do? And the answers can be painful. So focus on those rules, but it can be very helpful in certain circumstances. So it's definitely worth tuning into if you're part of those circumstances. And I think I already covered this. One of the huge disadvantages of restricted stock is that you have to pay withholding tax when it's illiquid, and you can't move it. The tax dates are fixed. You can't shift them. And if it occurs at a time when the stock is illiquid and the company's strapped for cash, it can be very painful. But I think we covered everything else. So, and I will note again the tensions there. If the employee makes the 83B election and gets capital gain on the restricted stock, the company loses the deduction. Again, that tension is present. So as a company, it's something you want to think through. I mean, they'll get a deduction, but it'll be very small because it'll be based on the value on the date of grant rather than what it's worth 5 years later when the stock is sold. Okay, restricted stock units are the next flavor of equity award agreement. I would say historically these were used very infrequently for private companies, but they are making a huge rise for companies, again, that are significant high-value companies that have not yet done an IPO and have not yet done a change of control, because they start to see a diminished value in options because their view is there's less upside in the company and there's more real value already earned, and so they want to give RSUs. RSUs, the right to receive a share of stock in the future, the taxation is the fair market value of the share of stock when it is received. Unlike restricted stock, when you're taxed on vesting, for the RSU, you can actually have vesting delayed. You do not have to tax, in fact, you do not tax it on vesting. You can delay the delivery of the share past vesting and then tax them then. The problem is, for those of you who encountered 409A, RSUs have to deal with Section 409A of the code, and it's the complicated tax rules on non-qualified deferred comp, and it can be very complicated to structure it. The so-called Facebook RSUs feel like they've worked a way around it because they do this double. Has anybody heard of these? What they do is they have service-based vesting, and they'll say you'll vest for service-based purposes if you remain employed, say, 25% per year for the first 4 years. But you don't finally vest unless there's a change in control or an IPO within 7 years of granting, and you vest on that event. And those are liquidity events. So the idea is they time the vesting with the liquidity. So they try to turn the RSU advantages into an option advantage. The problem is it's not always clean in the way that it works, and it's a little bit of pressure on the 409A analysis. And I've seen some companies that have done them that don't have the time limit. They just say if and when there ever is an IPO, you'll vest, and I'm not sure that works for 409A. But the flip problem is, if you have the time limit, think about the companies that made these grants in the last 2 or 3 years trying to hit for an IPO, and the IPO market is stalling right now, right? So they're going to have a ton of potential buildup in value, but what happens if the IPO doesn't occur within that 6 years? They're all gone. They're all lost. So it's a helpful solution, but it doesn't solve all problems. So, but something to keep in mind, you're seeing it more and more often, and it can be helpful, but it has to be fully understood. And I think I covered, again, the next page, advantages and disadvantages. Oop, I'm pushing on time. I got to get through. One other one I want to mention, go to the next slide. This is a very common startup. You see this a lot in Northern California. I would imagine a lot of you are starting to see this. If a company's in early stages and they want to offer the advantages of restricted stock or the advantages of stock options to employees and let employees choose, you do a maneuver where you do a non-qualified stock option that allows people to exercise, purchase unvested shares of restricted stock, and made an 83B election. So the employee gets to choose, I prefer the taxation of a non-qualified stock option, or I prefer the taxation of a share of restricted stock, and the employee can choose. And it's a really nice, a lot of companies like it. It's something that's offered. So if it's something if you do non-qualified stock options in your early stage, this is something, if you don't already do it, you may want to consider adding, because companies consider it a nice benefit for some employees. And at least then as a company, even if no one does it, you could say, well, you had the option. You know, this was something we made available to you. Okay, so next slide's and just more advantages and disadvantages on that. Then next slide, I gotta hit this fast. Profits, interests, only work on pass-through entities. I talked about them earlier. This really is the home run. I kind of call it the unicorn in compensation, because really the executive can get almost all that they want. The disadvantages of profits interest is that the person becomes a partner in the entity where they have the profits interest, which can lead to phantom entity or phantom income. You're gonna be paid on a K-1 from that entity. It can cause issues with your benefit plans, which if it's not structured correctly, you can end up being self-employed rather than an employee, which means you may be responsible for the employer portion of FICA. And you also may have to file tax returns in other states and countries if the entity you're a partner in does business in those countries. So it's sort of the home run, but it's not a small amount of complexity. And I will say the math of profits interests, for those of you who do the math on the upside of stock, I feel like the math is fairly simple. The upside of the math in profits interest is a lot more complicated. So if you want to go down this road, it can be very beneficial, but the complications have to be understood and worked through. Okay, a couple more. This is just a quick for those, this is one more. I have 2 slides on cash-based awards that are equity-like, and I will just, without getting into this too much, note that 409A is an issue, but this can appeal a lot to companies who want to provide the economics of the upside of an equity award to their employees, but don't want to issue actual equity. They don't want to deal with the complexity of having employee owners. And sometimes companies do this for a tier of employees that don't want to deal with the complexities of actual ownership, but they want to give a group of employees the upside. So you'll do phantom equity for mid-level employees, whereas the C-level may get actual equity. I see companies do that too. Huge disadvantages from the employee perspective. This is always ordinary income, and you always have to deal with 409A. There's no way to get capital gain in a phantom plan. It also puts a lot more pressure on drafting. If you grant somebody a share, the economics of the share sort of take care of itself within the corporate structure. If you grant someone a phantom share, you have to do a better job of defining the way you intend the economics to work in relation to a regular share. All solvable problems, just complexities that you have to deal with. Phantom, and then the next page, I just want to distinguish, phantom units are the cash equivalent of restricted stock or restricted stock units. Stock appreciation rights are the cash equivalent of stock options. Also cash settled, but I just want to note that. And then next slide, there's some more advantages and disadvantages, which I think we've talked about a lot of them. I'll pause here for a minute. One other thing I want to note for those of you designing these programs and thinking things through, make sure as part of your conversation, if it's with me, I will raise this. If you have other counsel, raise this. Ask about 280G. If your likely exit event is a change of control and you're designing the program, 280G plays out differently for these types of awards. For those of you who don't know what that is, it's a tax on individuals in the event of a change of control. If, pursuant to some math in the code, you're going to get paid too much on the change of control, it trips up this tax issue. Here's the painful part. To get around it for a private company, there's a workaround, but employees have to sign a waiver. So let's say you have phantom units that vest on a change of control, and you're entitled to millions of dollars. If you haven't thought that through, 280G may trip that up, and someone may come to you and say, well, bad news, you have to pay a 20% excise tax on all of that. Well, I didn't know anything about that. Well, I'm sorry, that's the tax rule. Okay, well, can we solve it? We can solve it, but to solve it, you have to sign a waiver and say, I agree, I don't get those millions of dollars unless the shareholders approve it. you got to take a legal leap of faith. And that is a very painful conversation in my experience if you've never been exposed to it. So I didn't put a specific slide in on it, but I do want to note that for people listening. It should be part of the conversation of setting these programs up to make sure it's understood.
On the next slide. So normally try to avoid kind of boring people with tax code section numbers, but this is one that often is referred to by its code section 1202. So 1202 is the small business provision that excludes 100% of the gain upon a sale of stock. So the requirements are you need to have a non-corporate shareholder, you need to have a 5-year holding period, and you need to have stock in what is a qualified small business. There is a limit. The limit is the greater of 10 million or 10 times the basis. So if somebody has made a made a $5 million investment, the limit is 50 million. It says annual limit, but that does not mean you get 10 million per year. Essentially, if you sell some in year 1, you sell some in year 2. In year 2, it'll look to how much you've used up of the 10 million in year 1. I won't go through the history of the provision, but in order to be eligible for the 100% exclusion, you have to have purchased the stock after September 27, 2010. If you have stock purchased before that date, the old version of 1202 will apply, which might be a 50% exclusion or 75% exclusion, but not the 100% exclusion. Stock must be acquired at original issuance. So this means buy stock from the corporation. Purchasing in a secondary transaction does not qualify. And you'll see there's a number of requirements, and linked to the original issuance requirement is this notion of no significant redemptions. And so that was really kind of an anti-abuse type rule where, if somebody's going to do a secondary market purchase, but it has to be original issuance to get into 1202, well, then the obvious way around is to say, okay, I'll just buy it from the company, and the company will redeem you out. And so to police that, there's a no significant redemption provision. In addition, you need to be a qualified small business. We're going to look at that, and there needs to be an active trade or business. So on the next slide, and I will also say, these 1202 rules are relatively complicated, and these slides are kind of a high-level summary. So, if you're planning something or you want to make sure you qualify, the devil's in the detail when it comes to these provisions. So, qualified small business is a domestic C corp, no foreign companies, no S corporations, no partnerships. You can own QSB stock through a partnership, but the partnership itself cannot qualify as being a qualified small business. Then when you make the investment, the aggregate gross assets could not have exceeded 50 million when you make the investment. And there's a before test and there's an immediately after test. The trickiest part, or the trap for the unwary part here, is that the 50 million method of calculating is, only something tax people would come up with, because it's cash plus tax basis of property. So, if you start a company in your garage with whatever $5,000 and it grows to $60 million in value, that doesn't mean you're excluded from 1202. So if you raise money and the valuation is in excess of the company's in excess of 50 million, that's not a problem, because when we say the $50 million limit, you look to cash and the basis. And so the basis inside the company is $5,000, or maybe zero, depending on what happened to the $5,000. And so don't look at the 50 million as being a cap on value for investments. Then the active business requirement basically means, it's defined in the negative. So any trader business is a good trader business, except, and then there's a long list on the slide of things that are not good. The theme of that list is personal services companies, right? Law firms, engineering firms, architecture, accounting, etc. Financial businesses like banking, insurance, farming, mining, and then real estate related things are carved out. Hotels, motels, restaurants. The one that I've seen come up a few times is health. And taxpayers have gone to the IRS for some rulings, from private letter rulings. So these are rulings that the taxpayer can rely on, but others can't necessarily rely on a private letter ruling. But those were situations where somebody had, let's say, software that was being used in the medical field or certain machines that they were selling. And so they got rulings that was not the business of health the way 1202 meant it, essentially. But that gets a little tricky, tricky enough for people at least to want to get a ruling. On the next slide is the redemption rule, and there are actually two redemption or two no redemption rules. There's only one on the slide. So this is the one that I mentioned where the company cannot have redeemed more than 5% of the value of its stock within, and I think at the end of the slide there it says 4-year period. That should be a 2-year period. You look at 1 year before the issuance of the new stock and 1 year after. Yeah, so in that period, no more than 5%. There is a 4-year redemption test, but that is no redemptions with respect to the person investing. The taxpayers making the investment in the 1202 company cannot engage in redemption transactions for 2 years before and after.
Can I ask a question now that I'm tuning in? What about repurchases pursuant to the equity plan? Does that count for this rule, or is it the passive shareholders? But if a service provider, you grant the CEO 5% of the company, CEO leaves, you buy it all back. Does that blow this?
If it's within a year, yeah, I think so.
Good to know.
Yeah, you can get into 1202 if you receive stock for services. It's the services or for cash or for property. But yeah, there is. I think so. Well, let me check that. But all right, and then I won't go, through all the details, but I want to mention there are a bunch of special rules in 1202 that you see there on the slide. Ownership through partnership. So, as I said, a partnership itself cannot be a qualified small business, but if you have a partnership that owns qualified small business stock, then that should work. But there's a bunch of traps. So where this comes up all the time in venture capital partnerships. So they make an investment, the company is a 1202 company. You can distribute, the partnership can distribute qualified small business stock in kind to the partners, and you can retain the benefit. But contributions from investors to a partnership might be a totally different story. It gets tricky when you deal with profits interests that Ryan mentioned earlier. So often the general partner has a profits interest. Let's say you have a classic 2 and 20. Does your 20% benefit from 1202? I think the answer is yes, but I think it's not entirely clear. And then there's some special rules about if your interest in the partnership shifts during the holding period of the QSB stocks. You want to be careful with that. Then there are some special rules about convertible securities, options, warrants, so that ultimately morph into ownership of 1202 stock. Corporate transactions, mergers, incorporations. There's a bunch of special rules that tell you, do you preserve 1202 treatment? Do you get tagged holding periods and tagged basis? How do you calculate your 10 times basis calculations? There are some rules about 1202 companies not being able to own too much real estate. And there are some special rules about offsetting short positions. So if you start to hedge, that could trigger taking the gain into account, or it could stop the holding period, the 5-year holding period for 1202. The other thing I'll mention is in the, what was it called? The Build Back Better Act. That didn't make it through, right? But the proposal in Build Back Better Act was to limit the use of the benefit of 1202 is going to be limited to, and I'm not, don't quote me on the exact number, something like taxpayers with incomes not in excess of like $400,000 or $450,000. So that didn't make it through, but I will say that this provision was kind of a sleeper in the code, where a bunch of people knew about it and took advantage of it. It's no longer a sleeper. I think a lot of people are aware of it, try to plan into it. Congress, not everybody in Congress likes it. Now, before we started this, I checked my phone, and I don't think the House has been called yet, but assuming the House goes Republican, I doubt there's going to be a ton of tax legislation actually making it through. So I would think 1202 will be safe for at least 2 years, and we'll see what happens after that. But the Build Back Better Act proposal had no grandfather. So if you had sold stock before and you're claiming the benefit, that's okay. But stock you already own, maybe have owned for 4 or 5 or 6 years, would not be grandfathered under that, under what they were thinking. So that something to keep in mind. If in 2 years things shift again and you've met the 5-year holding period, it might be something to plan into. Okay, with that, back to you.
Okay, thanks. So this slide I can do pretty quickly. Here's some points I want to note for deferred comp issues to avoid. These things come up more frequently than you would think, and I just thought it's worth mentioning to the audience. If you have any of these or these things come up in your company, think of these warnings so we can avoid them. One is the no good deed goes unpunished. Growth company, startup, cash is short. The executives think they're doing a great thing. They say, pay me less now and pay me more later when the company has more cash. That can be a 409A violation. It can trigger adverse tax consequences. You can always waive your right to compensation if there's no strings attached. So anytime an executive wants to say, I want to be paid less, you can pay them less, and there's no problem. Anytime there's strings attached of any sort whatsoever. So this came up a lot the last few years in the early pandemic. We'd get calls, hey, this executive wants to give up their comp, and they want to donate it to this fund to use for employees. Sorry, they have to pay taxes on that, because they're controlling the use of the comp. So it's their money and they're controlling the use. Or don't pay me now, the company's short, but pay me later. There's control on the back end, there's a right. So it comes up, it's a no good deed goes unpunished. It seems like something that should work. If the company truly is at a point of not being able to make it as a going concern and we can document that, you might be able to make this work for 409A, but we got to document it the right way up front. So if this comes up, an executive wanting to waive comp for any reason, make sure you call, because if it's not done correctly, that good deed could end up triggering an adverse tax consequence, which will make everybody upset. The next one ties to 409A2. I deal with this a lot with companies. They want to save on legal costs. I totally get that. So they think we're going to sign this initial agreement with the employee and then we'll get the lawyers involved later. The problem is the 409A analysis starts on the date the legally binding right arises. And once that arises, if there are problems, it can be very hard to fix them. So then we get involved, and unfortunately we're the bearer of bad news. Like the way this is drafted, we have problems and we can't necessarily fix them easily. So I just want to note that if you want to say something to an employee in an offer letter, hey, here's your cash comp, we're going to design this other program. When it is designed, we will work with you to make a grant. So it's squishy. There's nothing they can latch on to. Or, you know what, you'll be eligible for a grant, but we don't know what it'll be. That's fine, because you're not promising anything. The weird ones are when somebody says something like, we don't have a plan yet, but we agree to make a grant to you of 5% of the company, or a cash grant that will entitle you to 5% of the profits. And then they just go, period. And it's like, okay, we'll design it later. That won't work, and it can cause a lot of problems. So just be careful, when you sign offer letters, that it only has cash comp. Anything else, it has to be vetted to make sure it works for 409A. So by cash comp, I mean base salary. Anything else should be vetted for 409A. The other one is you see sometimes in companies that are cash strapped to pay with a promissory note. So I owe you $100,000. I'm going to give you a promissory note for $100,000, and I'm going to pay you over 5 years. If you're willing to pay the tax on the $100,000 promissory note when you get the note, fine. But that's a bad deal because you're only getting 20% of it, say, and you have to pay tax on the whole thing. But if you delay taxation, that will not work. That's a 409A violation. So don't pay with promissory notes. And in fact, I see this sometimes in equity plans where company will reserve the right to pay with a promissory note on a repurchase or a cash out. You have to be careful there too, because if it's comp, it can cause 409A problems. Okay, so next slide is a combo between Rimmelt and myself. I've had this fact pattern come up several times in the last few years between Rimmelt and I. There's a tension coming for companies that are growing and the founders or initial management have a lot of equity and they want to sell some. So they have common shares. The investors are coming in and the investors are buying preferred shares. And they say, well, we want to sell, we want to liquidate some of it. Okay, but we want to sell our common shares for what the preferred shares are being sold at because it's a better price. So, but you don't have preferred shares. So the way that that's facilitated is the company buys the common shares back at the higher price and then issues more preferred shares to the investors. That will create a huge problem with the company when you go to make your next stock option grant because you now have documented evidence that your common shares, which are what the options are granted on, has a huge value that's not accurate. And that messes up your whole stock option program. So if you do that, it's going to create problems. There's a solution we've seen, and if you put this in place in advance, we think it works, but you got to do the work up front, which is you create a new class of shares for the founders called FF stock. And I'll turn it over to Remmels, but that class is a different class than the common, but then it can help solve this problem. So
That's right. And I'd also say, if I didn't put you to sleep in my 1202 piece, that this is where the redemption piece comes in, right? So because if the investor says, okay, I want Series A preferred, the founder has common, and so you do the redemption of the common and then selling the new Series A. Well, the new investor there might not get 1202 benefits because of the redemption issue. Well, actually, as I'm saying that, I'm realizing that the FF approach doesn't entirely solve it since it'll be a secondary purchase, but it's tax-free to the investor, to the Series A investor. You buy the FF shares, they will be automatically converted into the whatever class it is that the round is. So whether this happens in the A round or the B round or the C round, the FF will go into the round that is being raised at that point. And it avoids the redemption piece. So I guess it doesn't help, I guess, the investor that's coming in new, but it helps on there are no general redemptions rule, the 5% rule under 1202. It just doesn't help the actual new investor. Now we have, if you don't have FF shares, what do you do? We have seen situations where you can take common, convert it to FF shares, and then sell the FF shares. You just want to be a little careful in the planning, right? That if there's already an investor and binding agreements, then it gets a little tricky. But if you can see in the horizon, hey, I don't have FF shares outstanding. I've got regular common, but I might want to be able to take advantage of the FF approach. Then you can get into that structure ahead of time and then take advantage of it when needed.
Oh, yeah.
If you were converting an LLC into a corporation, could you issue FF stock in the conversion process?
Yeah, so the question is whether if you convert an LLC treat it as a partnership into a corporation, or you can then do the FF shares. And I think the answer is yes. So converting an LLC or a partnership into a corporation, that's an incorporation transaction, and you can, the FF shares are for tax purposes treated as common because they participate in the upside, just like the common does, pari passu. So you can do a combo. You can issue common and FF, for example, or only FF. Anything else on FF from your perspective?
No, I guess I think if this is something you think might be an issue, but it's not necessarily an issue yet, the only downside, I think, to doing it now is just the legal cost of doing it, because the transaction of converting the founder's shares to FF stock, we believe, is tax-free. And it's easier to argue it's tax-free when you're doing it, to Remolt's point, when there isn't a deal on the table. If the deal's already on the table, it's arguably a transaction that you're changing something for a certain value for something that now has more value. But if you do it when there's no deal on the table, so you prepare it, you lay the groundwork, I think there's a better argument, or we think that there's no taxable transaction on the exchange of the common for the FF stock, right?
Right.
So better to plan ahead if it's something that could be an issue on the horizon.
Okay, so then the last topic we had, Up-C structure. So 1202 and other than profits interest, most of the things Ryan talked about in the 1202 piece is for corporations, so a taxable entity. But if you start a business as a flow-through, so you start as a partnership or an LLC, taxed as a partnership, now, and I'll say most of the time when venture capital funds come in, they prefer to invest in corporations. So they'll say, please convert your LLC into a corp, or it won't give you the money, and maybe you can get away with telling them use a blocker company. But let's say you've stayed in LLC, and then there's an exit. Now, if you just have a regular purchase, so buyer buys LLC, for tax purposes, that's an asset transaction, and the buyer gets a step up in the basis. So if you're selling an LLC, make sure buyer pays you for the benefit that they get in terms of having a higher tax basis. That's depreciable. When you buy a corporation, you buy the stock, and the inside basis of the assets in the corporation don't step up. So there's no benefit to the buyer. An Up-C structure is kind of a hybrid structure where an LLC partnership goes public, where, many years ago when people weren't doing this structure, they would convert the LLC into a corporation, and the corporation goes public. And what happens is that the basis and the assets just transfers over. So low basis stays low basis. What the Up-C structure does, if you go to the next slide, you can see a picture, and I'll try to explain it in something that might be simple, is you have a public company that goes public. You have founders who own a partnership that want their partnership to go public. And the way you do that is by not having the LLC go public and not converting it to a corporation, but you keep the LLC as a flow-through, and it becomes owned by the public company. Public company raises the money, puts it into the partnership, or it can buy units from founders. And what happens is that the public company gets a step up in the basis inside that partnership. And so let's just say most of that is goodwill, and goodwill is amortizable over 15 years. Then what happens is the public market does not value tax attributes. The public market doesn't say, oh, you have a great tax, high basis, you're going to depreciate and amortize, you're going to pay less in taxes. Everybody does earnings before, interest, tax, depreciation, et cetera, right? They look at EBITDA. And so what the Up-C structure essentially does is it says, okay, public company, you're not going to pay taxes because you get a step up. We, the founders, want you to pay us for some of that tax benefit that is under a TRA, or tax receivable agreement. And on the next slide, you can see an example, just to kind of see how impactful that can be. So let's just say, you know, you got a business with, you know, that's valued at 300 million, and the whole thing is a step up. So it's a $300 million step up, all allocable to goodwill. So that gets amortized over 15 years. So that's $20 or 20 million a year, 300 million divided by 15. The tax rate is 25%, so that's a 21% corporate rate. And let's say there's a 4% state rate, so 25%. The tax savings is 5 million, 25% of 20. And the TRAs typically pay out based on a ratio. So 99% of these agreements will pay out 85% to founders, 15% retained by the public company. So that means that of the 5 million annual tax savings, 4.25 go to the founders for a total of $63.75 million. And a ton of people do this. If you have a flow-through entity, you don't do this, you're essentially leaving money on the table. The private equity funds love it. There's I'm sure you're familiar with the SPAC transactions. There's a lot of de-SPACs with flow-through entities where this is being done. And it's kind of a win-win in the sense that between the different parties, the benefit is coming out of Uncle Sam, essentially, right? There's a creation of a tax base, a step up that is shared. It's between public shareholders and the founders. So hence the win-win. On the last slide of our substantive piece, at least, the benefits are founders. Until the founders exchange the public company stock, they are in a one-layer tax environment. They have pass-through treatment. They can get liquidity because you can exchange your units for pubco stock, so you can sell whenever you want. Sounds a little morbid, but it's like the perfect estate planning thing, because what happens is there's no tax when you put the transaction in place if you're a founder, but when you die, your kids get a step up in basis. They then exchange for public company stock, sell it in the market, and they have tax-free money. So if you love your kids, this is what people do, including for real estate. They'll do it for UPREITs. You can contribute to the REIT partnership, your property. So people use it for that kind of planning too. So with that, I think it's time for questions. I don't know if there's anybody here. No questions online. Any questions from somebody here? No? I guess that means it was clear.
Quick question.
Uh-oh.
But I need a microphone. So Paul and I are going to start a company. It happens to be one of the ones that's allowed to get 1202 stock, but we don't have time to run this company. And we're going to hire one of you to be the CEO, and we're going to give you 15% of the company. You get to decide the structure and what device we use to compensate you with that 15%. What do you choose? Don't look at him. You choose.
I choose. I thought I was waiting for him to say the type of entity that was better. So it has to be a C corp, right, for your 1202?
Yeah, I would. What business are we doing?
One that qualifies under 1202.
Yeah, and it's just getting off the ground.
Paul has actually invented a widget.
Yes. But the widget doesn't yet have any value. It's theoretical. Yeah, I would do 15% restricted stock and do an 83B election and hold on to it. And
In a C corp.
in a C corp, yes. Then the idea being you'd pay whatever tax based on the theory, which hopefully is low. You pay that, and then it's capital gain from there on out. But you get the same retention value for the CEO, because if they leave, you get the stock back.
Okay.
So
That's what the comp guy would do. Tax guy?
Well, if there's startup losses, I might start as an LLC, use my losses against my other side businesses, side hustles, and then look at the political landscape. What's the chance that 1202 gets canned? because we're going to make a lot of money, so we're going to be above the bracket where they nix it. So, and then as soon as we turn profitable, then either stay as a flow through, and have it be profits interests, right? Or at that point convert to a corporation, and then try to take advantage of 1202. And then, and we would check that right at the $50 million mark.
49.5. So the lesson here is the comp guy just wants to get paid. The tax guy wants to optimize the taxes to the absolute last penny. All right, let's give him a round of applause. Thank you.